It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
Welcome back to Real Vision. I'm Ash Bennington. Today, I'm joined by Ben Miller, CEO and co-founder of Fundrise. Ben, welcome back to Real Vision.
Yeah, thanks for having me.
Excited to have you with us today. My first time having a conversation with you. Ben, let's start out big picture. Give us your overall view, top down, of what's happening from a macroeconomic perspective in the US right now.
I mean, I think I'm with the consensus view in the short term, which is fairly positive with a gradual softening. So so as I lay out some of the more interesting facts and data we have as we operate across the country in different markets and different asset classes, to give you like my sort of background assumption, is that the basic slowing of the economy is happening. It's happening gradually. It's happening because of rates, and the economy otherwise is fairly healthy. And for the moment, the Fed looks like it's succeeding in achieving a soft landing. With I think I have a few caveats that are contingent over the next 6 to 12 months, but that's I think my basic assumption.
Well, that naturally begets the question: what are those caveats, and how significant do you think they are?
Yeah. If one advantage of getting older is that you start feeling like you've been here before. And so I graduated from college in 1999. And so I kind of went through 2001, the tech bubble. And then I was like almost an adult when I went through 2008 financial crisis. And now here it is, 2024. And so this lag between the raising rates and actually seeing the impact is what's happened every other time in my experience. Just to go back to 2008, I was in real estate in 2008. We had like $500 million in real estate back then, big real estate partners, and the housing market started to get really choppy in 2006. The credit markets closed in July, August 2007, and the economy and the stock market blew up in October 2008. So very, very long lag. I think we're still in this lag period, and in some ways, there's one of the great things about America is that it's always the most of everything. So we have the most amount of debts, total U.S. debts, public and private, is about $100 trillion. When you talk about that, and then we have more fixed rate debt than sort of ever before. And those two extremes are counteracting each other, because it basically, the most amount of debt means that interest rate policy should have the biggest amplified effect, because if you have 100 trillion times a 10% interest rate versus a 2% interest rate, right? It's much more interest payments. At the same time, you have all this fixed rate debt, and that's slowing the impact because most people's interest payments haven't reset. So you have sort of the biggest effect and the slowest effect at the same time. And that's actually, I think, flummoxing most people who expect things to happen faster than they usually do.
Yeah, I mean, this is Jerome Powell's great phrase, long and variable lags, that we keep hearing about right now. Federal funds rate between 525 and 550 basis points, the highest level it's been since, I guess, going back to the pre-financial crisis, pre-GFC era in 2007, 2008 time period. You mentioned this idea of it appears to be happening slower than expected. What are some of the mismatches, misconceptions, or misperceptions about the way the rate cycle influences asset prices, growth, and some of the other challenges that may occur as a consequence of this, as you mentioned, this very large fixed debt burden?
Yeah. So that Jerome Powell quote, long variable lags, is actually he's quoting a famous monetarist, Milton Friedman, from a paper Milton Friedman wrote in the 1960s, I think in 1963. So the Fed's been contemplating the long variable lags for a long time. But what's changed? A lot's changed since then. Just to name a few, because you have to sort of parse this and figure out which of these changes, how they're operating, which of these changes are causing what effects. So one of the big changes that people take for granted now is that back then there weren't any money market funds, and money market funds were created, I think, in the 80s, and so before, since all money was with banks, there was a much more direct channel for the Fed to affect the economy. And now money market funds have sort of intermediated that, and that's created like a more challenging Fed policy.
By the
Two,
way,
never before has the
explain that a little bit,
Fed.
a little more detail. The impairment of
Oh,
that channel as a consequence of money markets soaking up greater liquidity in the U.S.
this is a kind of a mechanics or plumbing question, and I'm not a monetary mechanic, but what happens is if you have dollars, instead of putting them at the banks, you put them at money market funds, and so they don't circulate in the economy the same way that they did when all the money was at the banks, and um, that causes essentially, rather than, if you raise rates, the banks and have to pay more on overnight lending, and that used to force them to slow down lending. So there's just like a huge part of the dollars or depository base that operates as the money supply and the money velocity, which used to sit entirely underneath the Fed, now sits sort of fragmented away from the Fed. Um, and so that means like some of their policy doesn't, if you raise rates, the banks have to essentially used to have to raise rates as well, and that would cause this sort of like channel effect, a kind of a sequence. Now the not only a lot of this money not circulating until money market funds don't lend the money out to businesses and borrowers, right? That's the biggest difference, right? Is that like the money bank would essentially raise the rate on borrowers, and now money market funds essentially doesn't do that because it doesn't lend the money out to anybody but the U.S. government. So that's like does that track?
Yeah. So the TLDR, and I know this gets really complicated really fast for folks who are following along at home, but the TLDR answer is that you have money that used to sit with banks that were directly regulated by the Fed. Some of that money no longer in those directly regulated institutions where they have the control of essentially using the monetary policy levers. Now some of that's in the money market. It impairs their ability to directly affect the flow of capital, the economy, because of the multiplier effects with traditional commercial and industrial lending and personal lending.
Yeah, exactly. And I mean, there's so many things that are different. And I mean, I want to get to real estate where in technology where I have more on the ground expertise, but it's just the big things. I always find that if you want to understand something, you need to start at the top and start at the bottom. So you work from top down and you work from the bottom up. And so some of the top down things, it's easy to lose track of these big things. So we have to mention that the Federal Reserve owns now $7 trillion of assets. That's never before happened. Let me just try to do a counterfactual and help people imagine how consequential that is. So let's just say that those $7 trillion of assets, which are largely long-dated bonds, right? Largely treasuries, mortgage-backed securities. In the last decade, the Fed was the marginal buyer of mortgage-backed securities. They bought 25% of all mortgages that were securitized and issued by the market. So that was a huge driver of rates. And so typically, if you saw rates move from what was like, let's say long treasuries were 2 to 3 and they went to 4 to 5. So normally those losses would sit with in the private market in with banks and private owners, and they would have those losses, and those losses would cause great economic consequences. But right now the Fed is sitting with those losses, and they modified their accounting policies so they don't have to recognize those losses. And so the huge economic or financial consequence of raising rates is not being borne by the economy. And so that's like part of the reason why the impact of higher rates has been mitigated. I could go on. I mean, there's another really interesting thing, just because when you're thinking about the channel, is that I think the top 15 banks have 75% of deposit assets in America, and the interest rate that you get as a depositor at JP Morgan is something like 0.05%, 0.01%, something really, really small. And so what used to happen is that the deposit rates had to climb with interest rates, and that would force the banks into like a lot tighter position. There'd be more, could have to basically be less aggressive in lending because they had much more expensive money. But because essentially that hasn't happened, the money's been more sticky. The banks have ended up in a healthier place. So there's a lot of, we go on and on. The point is that, I guess we just go back to this one other thing, fixed rates. So 76% of all mortgages in America are fixed at less than 5% a year. 30-year fixed, less than 5% a year interest. So that means that you have most of the consumers, let's say half the consumers in America, are very healthy with no stress because they have low mortgage payments, and just for every asset there's a liability. Those consumers have really low fixed rate debts. Somebody's holding those debts, right? Somebody's holding like 2.5% 30-year paper, and that should be marked to huge losses. It's probably the Fed. It's mostly the Fed, but so it hasn't had a large negative effect on the economy. So these are big things happening. There's just a background drivers that we have to keep in mind as we then go down to the next level of like, well, what does this mean for real estate, or what does this mean for stocks? What does this mean for different sort of sectors in the economy?
Well, that really is the I guess the $20 trillion question. Let's talk a little bit about that. Talk about essentially the channel by which these mechanics, the monetary plumbing, flows through to risk asset prices.
So what's happening in markets, which has confused me, is that risk assets actually have stayed fairly expensive. And so question is, why has there been so much supply of money into risk assets? Because normally the price of any asset, just like the price of any good, is a equilibrium of supply and demand. And so I think that's often people who are looking at a value of something think it's priced on some kind of fundamental analysis. But most assets are priced by supply and demand, and supply of money is arguably the most important supply to track. And so what should be happening with higher rates and quantitative tightening is supply of money should be declining, which should cause asset prices to fall. And by and large, they haven't fallen as much as people expected. I expected. And I think that there's two countervailing factors here. One is that although on the short end of the curve, there's been much higher rates, the long end of the curve actually hasn't come up as much as you might imagine. It's still in the low fours and stayed in the low 4% for the 10-year Treasury for the last year, with a few moments when it hit 5%, and when it hit 5%, the U.S. Financial market started to have a seizure, and so that is what has mostly spared the financial markets from collapse. Is the long end of the curve has stayed low, and there's, I think, organic and inorganic reasons for that. The organic reason is that people believe that in the long term rates will come down and interest and inflation will come down, and that has proved out to be more or less true. And so there's a lot of confidence. The Fed likes to say confidence in the Fed. I don't think that's the only reason, but that's actually confidence generally in the U.S. system. If you want to be really optimistic, has kept the long end of the curve low. And then obviously the other part, which everybody on the show probably knows, is the Treasury has shifted their borrowing to the short end of the curve, right? So instead of borrowing long end money, which would cause demand for Treasuries, right? Supply of Treasuries to spike, which would cause price to go up. The Treasury Secretary has been borrowing at the short end of the curve, and that's basically undersupplied the long end. And since price is supply and demand, by undersupplying Treasuries at the long end, it's kept rates down. So those are we're kind of in the weeds here on market functioning. But the other thing that's been surprising, credit spreads. And actually, I have a slide on this. So let me just give you a little background before I can show you the slide, because really interesting data. So Fundrise, we have a platform. We invest in real estate. We invest in private credit. We invest in tech. And as part of this portfolios, we cross over different markets. And so we have been crossing over into, especially when the markets blew up, credit markets blew up in September 2022 or summer 2022. So we started buying asset-backed securities in August, September 2022, maybe even July, sometime around that period, we started buying asset-backed securities. We really got a lot more knowledgeable about that market. It's a really interesting market because the asset-backed securities market is like really a window into the credit markets, but most people don't get to see what's happening. And so we were buying, single-family rental portfolios of newly issued securitizations, and the sort of like the risk tranche we bought. Sort of the most risky tranche would be like a triple B or like an E tranche, just like a 60% LTV. We were getting like 12, 13, 14% yields.
Let me just explain some of this.
Yeah, please do.
You want to unfuck your shit? This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Triple B is essentially the lowest grade of investment grade security. You thought you were getting paid at that level at 12%. You mentioned 60% LTV. This is loan to value ratio. This is a measure of risk in the underlying portfolio of the mortgages that are aggregated into these asset-backed securities. You thought that you were getting paid for the risk, presumably at a level beyond where you were taking. You thought you were essentially getting paid very well for the risk at that level. What made you confident in those triple B securities? Obviously, that's a number that's significantly higher than where treasuries were at the time when you were buying them. Talk a little bit about that asset allocation decision.
Well, so what happened? I mean, the asset-backed securities market is so funny. It's very institutionalized, and so what happened was in that moment, the risk buyer, because if you have a $1 billion securitization, there's the sort of they call it the bottom of the stack, or the most risky part of the stack. Someone has to take that risky tranche in order to the rest of the securitization to sell. And so that risky tranche, there was no buyer for that in the market. All the traditional buyers had gotten very antsy and had left the market. And so there was just nobody. There's nobody. And we showed up as the only, I mean, we made the market. We were the certificate holder, they call it. And so
there's no bid. When you come in,
there was no bid. There was no bid. Well, I mean, exactly. I mean, the investment bank's trying to basically make a book. I mean, build their book. And I give you a great story because it's like we were so different than normal securitization buyer. We started getting smart. The reason we got into securitization market is that in that June of 22, we had a large portfolio of build for rent housing. I think about $500 million. And we were taking it through the securitization process. I was meeting with Moody's and the rating agencies, and they were analyzing my portfolio. And I was getting pricing, and I was understanding how they think about it. And by midsummer, I was like, I don't want to be a seller into this market. I want to be a buyer. So and I could tell you a great story. I don't know how much you know about real estate, but we were with one of the rating agencies, one of the most illustrious, and they were looking at our portfolio and they said, "Who's your property manager?" And I said, "Cushman & Wakefield." And they said, "Who's that?" And Cushman & Wakefield, I think, is the largest it's top 3 largest real estate companies in the world. Like, it's really low. I mean, so I was like, oh my God. Wait a second here. If you're the ones pricing this thing, I gotta go. There's some market inefficiencies probably embedded in these securitizations. So, anyways,
and I think most of the people who are listening to this are probably having flashbacks to The Big Short.
Yes, yeah, exactly. So what happened is they have these securitization conferences in Vegas and Miami. So we went to one in Miami, and we're investment bankers are sort of taking us around. You meet with all the trading desks, and you go into the meeting. And you say, okay, like they ask you, what label do you buy? And we said, I don't know what does that mean? What do you mean? Like, what are you talking about? They said, well, do you buy like triple A's, triple B's, and double A's? Like, what do you buy? And we'll say like, we said something like, I don't know, whatever makes sense. Like, we kind of look at it and say like, okay, that's a good price, that's a good yield. And they're like, well, so you're a non-labeled buyer? I said, I don't know, I guess so. Wow, that's really rare. And so it's like they buy the label, they don't like underwrite the asset. It's like, and so when the market sort of fell apart, someone had to underwrite the asset. Someone had to look at the asset and say that's a good price. So it's like usually the market doesn't operate on fundamentals in the same way. In like a healthy market, it's more like a factory. Like, scribbles go out the door, you buy them on spread. And so the market, the factory sort of had stopped, and we restarted it. And that was like, and now I guess that's 2 years ago. And we watched, and we've been buying ever since. We've been at the market buying for the last 2 years, probably put out, I don't know, I mean, $100 million or something. And the market has just completely shifted. And in the last few months, it then reversed. It flipped. Where now the risk tranche prices, where you look at the fundamentals, and it makes no sense. And that's why I was going to show you this slide, which if you want to pull up this slide, I can try to walk through it. It's a little technical. But
let's do that, because this is a really incredibly interesting conversation. I just want to make sure that all of our viewers can come along with you, because obviously this is a straight up institutional market, something that probably lots of retail investors don't really understand this level of granularity. So don't worry if you're a little bit lost right now. Ben and I are going to unpack all this for you in the slides we're about to look at.
Yeah, and just to give you a sense of how institutional you're talking about, to be a buyer in the asset-backed securities market, you have to be a QIB, a QIB, and a QIB requires to be, you have accredited, which is $1 million net worth. You have qualified purchaser, which is $5 million. To be a QIB, you have to have $100 million. So $100 million minimum to be able to buy 144A securities. So this is like a very institutional market. These are 2 recent issuances that just went and cleared the market. We did not buy either. And the questions that the investment community was asking the our analyst on these were questions like, okay, like what, when you look at this, the LTV, you say, oh, so there, the loan to value, LTV, that in the middle there is the, people are familiar with buying a house, getting a mortgage, you get 80% mortgage. They look okay, 73% or 81% loan to value. That doesn't seem that aggressive. We were getting for the same kind of tranche, it was like 60%. So obviously, like loan to value is really, you could say it's normalized, but then you have to look at, okay, but what's 80% of what, right? Like, so if you buy a house for $200,000, you have 80% of that. That's very different if you buy the exact same house for $400,000, 80% of that, right? So like the price you're paying for the whole asset like matters more than the 80% of value. And so what you're seeing here is the cap rates that are implied by these securitizations, which is
all right. We gotta jump in and explain cap rates.
yeah.
This is a measure of the cash flow that comes off a property. It's based on the net operating income, but give us the detailed explanation for beginners to understand cap rates.
I think the easiest way to think about it is that stocks are priced at PE, price to earnings. So a 20 PE or 10 PE, right? That's, everybody's familiar with that. Real estate is priced inverse of that. So the earnings divided by price. So a 10 PE would be a 10% cap rate, right? Or a 20 PE would be a 5% cap rate, right? So 20 is 1 divided by 20, right? So what you're looking at is essentially a multiple. So a 4 cap rate is like a very, very high multiple. And obviously, like in a way, like let me just do a 1% cap rate would be 100 PE, if you follow. So what's interesting about looking at this cap rate of 4% in both cases is that we can go out and we are buying housing at probably 6% cap rates, maybe high 5s. So you're essentially lending at a 20 to 30% premium to where I would be buying the asset. So like if you look at the debt yield, 5.62 or 4.82, your debt yield is actually effectively at a price per square foot or a price per whatever price per pound. That's worse than if I were just buying the whole asset. Does that communicate?
Okay, so let's just go through this. Higher cap rates, all else being equal, mean more cash flow coming off the property.
Yes, but it also like effectively tells you how much you paid for the building or how much you paid for the property, right? So, here you're saying like $215 a house, right? $215,000 a house, $285,000 a house. If I could turn around and buy that house in the market, and buy it and own it for $200,000 a unit, right? Or $250,000 a unit, then you're lending above the basis that you can buy it at, right? That's what's so interesting. And so, like, or here's another way to think about it. If you're paying so you look at the down on the bottom, this is the price the issuer is going to pay 211 over 4-year U.S. Treasuries, right? So that means that if your Treasury is at 4%, and you have a spread of 211 bips, and you're paying 6%, 6 and change for the to the lender, right? But the property only has 4% cash flow, right? So how do you pay 6% cash flow to the lender if you have bought the property for a 4% yield?
If I'm understanding this correctly, what you're saying essentially is that the valuation of the debt is mispriced relative to the underlying asset, and you can actually buy the debt lower than you could at the underlying asset price, which would suggest that ultimately the value of the debt would rise.
No, the opposite. You can buy
The
the
opposite?
you're buying the debt above the asset price of the property.
So why would
That's-
you want long if you were buying the debt above the asset rate of the property?
You shouldn't. This is a very unhealthy sign for the market.
Okay, so but these aren't the triple Bs you were long then.
Now this is what happened last month, not 2 years ago.
Got it. Okay, got it.
Sorry, I wasn't clear. Like this is where the market is today. Not where 2 years ago it was like 50% more than this. You know, the cap rates were 6, the debt yields were 9, the LTVs were 60%. Your last dollar was, $100. I mean, like, this is like there's nothing there. I'm trying to say today we're not buying this market today. I'm just saying like this is so maybe it's just too technical, but like the essence of what this is saying is that you're today securitization market lending to borrowers at higher prices, like they're lending above what I think is the actual purchase price of the asset.
And that's the key. And it sounds like a disastrous situation.
Is it a disaster situation? So let's let's jump back to maybe this just let's jump back to normal back and forth here. But like the bet is that over a 5-year term of the loan, the price of the house, price of the underlying asset appreciates. And so that like 5 years from now, if it appreciates, let's say 5% a year, that's 25% appreciation over 5 years. And then they can sell the house and they're good, right? So it's a bet
that's a bet that the underlying value of the collateral is going to rise to meet the debt service pricing on these instruments, which is it would seem to me to sound more like an equity type of bet than a fixed income kind of investment.
Yes, exactly. So okay, so I try to bring that because it's like it's a signal, right? Because I was saying to you 2 years ago, the signal was the opposite, right? It flipped, the complete opposite. Now, what does that mean? Why is it happening? What does that mean? So there's a few possibilities, and certainly it's a little bit. This is so fresh, right? These are things that printed in the last couple of months. So there could be macro reasons and there could be micro reasons. So let me just do some of the macro. The macro, I think, is that there's been the hot new thing is private credit, and there's been a ton of money raised for private credit. I mean, I don't know how much, but probably hundreds of billions. But they actually have a really hard time putting it out. And we have a private credit fund, but our private credit fund is like a more surgical and smaller. But so what's happening is all this supply of private credit money is flooding into the market. And if you're a lender, you more or less lend when somebody buys. You have to have a transaction in order to be a lender, right? You can't lend to somebody if there's nobody borrowing.
Right.
And the borrowing has dried up because there's very few people buying today. And so there's not enough transactions. And as a result, the few transactions that come to market, like a securitization, is oversupply of money, oversupply of private credit money. So I think that's a factor. So
oversupply of private credit money.
That's oversupply of money. It's not just private credit. It's also probably debt funds, like bond funds. There's lots of people who buy, bank funds. So it's not just private credit. I mean, it's so you might just say oversupply of credit markets, which is counterintuitive to what you think would happen when the Fed raises rates and pursues quantitative tightening. So that's.
Let me just pause here and
yes, please.
So that people who are watching this can get a sense, because it sounds like you're discussing a potential fragility in these markets, potential risk ahead in these markets. So let's just walk through this just so people can get a big picture, because obviously this isn't something that I deal with every day. And it's hard for me to get my head around. So I can imagine that people at home are probably having similar questions. First, for people who are not sitting in front of a Bloomberg terminal, who don't have QSIPs on the ABS that we're looking at, is there a way to measure the pricing in this market that's publicly available for free on the internet? Or is this something that you need to have specific information about the assets that are trading for qualified institutional purchasers? Is there any transparency in this market that we can see?
Not that I'm aware of.
Or a proxy? Or a
Yeah,
proxy.
I mean Bloomberg terminal is like, and even Bloomberg terminal, like, it's a lot of times you don't get great data from the offering materials, and you have to go supplement it with like additional data about real estate markets. So I don't
Okay,
think
so
so. I
number
think this
one,
is
first
Bloomberg.
thing that people need to understand, this is not transparent. You're not able to see this on your screen right now. That's what makes it actually very interesting for people who watch The Big Short. You know this idea that you're not able to see the pricing on it. I imagine these things trade probably quite infrequently. When they do trade, they trade in large blocks. Some of them may be private transactions. I don't know what the ability to see that stuff sort of listed is. Okay, that's the first thing you need to know. This is not something that you're seeing on your screen right now. So let's unpack this and talk a little bit about what the implications are. It sounds like for essentially rising risk in the underlying ABS and the mortgages behind that. Talk about what does this mean for people who are listening to this right now, other than the fact that it sounds like you've made a pretty big bet on this market.
Well, we did, and then we shifted. But it's I mean, this is what's so interesting is it's you could see it as a positive sign, and the positive sign is that the risk had left the market. Risk takers had left the market 2 years ago, and there were was a lot of fear of a recession, and now the risk takers are back to the market. They're back, and they're back in spades, and so I do think it does reflect kind of the stock market's like surprising climb is that there's plenty of risk money out there. And so if you could imagine a scenario where we have a soft landing because there's enough flow of capital where businesses and borrowers can get access to capital, even if it's more expensive, they can still get access to it. A lot of times, like 2008 financial crisis, it wasn't just about price. There was just no money. You couldn't get money. It was gone. So I think that you could take it as a positive. I think you could take it as a positive in the short run. And then it raises question in the longer term because it doesn't feel like that is necessarily good risk, that it's balanced. But if when I said there's macro reasons, micro reasons, I think the micro reasons are single family has been very healthy through this downturn, much more successful than people thought. There used to be a saying that it's safe as houses because housing prices never gone down. In 2008, they went down and people started thinking housing was risky, but actually traditionally housing is very safe. And I think that the institutional market is starting to see housing as a much safer bet than I think most people appreciate. So I think that there's
So that's an interesting statement. I want to zoom in on it. The institutional market is beginning to see housing as a much safer bet than people realize. Now, this is something that ties into, again, things that aren't necessarily super transparent to people. Private credit markets, private equity markets. The idea that there's been a tremendous increase in the amount of private capital flowing into real estate development on the equity side, on the private credit side. So this is an interesting question. I just pulled up on my screen here the S&P Case-Shiller 20 City Index. I'm looking here over a 10-year period. I'm looking at a 10-year chart on this going from about 170 in April of 2014 to where we are right now at 333. This has been up at a 45-degree angle over a 10-year period. And it sounds like the crux of that, and by the way, slight dip during the pandemic, and then just continued at the same slope, the same rate of trajectory upward. This seems to be consistent with what you're saying of the fact that there are institutional markets that are supporting this. I have to ask the obvious question is there risk in this? Is there the potential that we've seen too much capital flowing or overdevelopment or some other imbalance in these markets?
Yeah, you said development. It's these transactions are for existing homes, but just that. But I think no in the short run. I mean, I think this is. I mean, I'm very worried about it, but I'm always worried about everything, and so it's not a good gauge of whether or not everyone else should be worried. Uh, so the micro reasons are that what happens with institutional money is that things go into favor and come out of favor. And so housing has gone into favor because of the run up you said. One, two, because of the resilience during the 2022 from COVID to now, that resilience, the institutional market really values resilience, not just growth. And then three, a lot of money has to go somewhere, and it used to go places that are no longer available to it. So office was a multi-trillion-dollar market, and the money can't flow there. A lot of private equity CLOs and things like that, where you're funding private equity funds acquisitions of real estate. I mean, not of real estate of properties. Sorry, private equity funds acquisition of businesses.
These are the collateralized loan obligations.
Yeah, you're exactly. And so private equity funds aren't buying anything, so there's no borrowing. So there's actually not that many parts of the market that are still transacting. And so it's a combination of there's not that many choices that you can put your money into, and it has done pretty well. And just like, I mean, my experience in 2008, just like individual investors, they always chase the past. If a line is up and to the right, they buy it, right? Rather than saying, oh, is that a sign that it's overbought? So, but let me just give you another, because when you look at these markets, what I love about being across multiple asset classes and multiple I'm a private market, public markets, you can go look at the asset from different angles. And so another way to look at it is we are a lender into the home building market. We have 10,000 lots, and we lend to home builders who build homes. And that we went into that market in 2020 maybe 2021.
Now, is this private credit or public debt markets?
This was private credit. So we have a private credit fund. This is where we bought asset-backed securities. And we are also in that private credit fund, mostly a direct lender. And so when the housing market sort of cratered, we lent to home builders because we found it really attractive. And I can talk about sort of how...
Presumably you found it really attractive because of the yields you were able to generate on it. In other words, if there's no bid in the public markets, you probably have the ability to lend at a pretty attractive rate from your perspective.
Yeah, I mean, it's I'm like I can jump to a new market and talk about it, and it can be. I hope I can sort of like bring people along, but like the way home builders build homes today is they buy, let's say, a $20 million piece of land that's got 500 lots on it, and we would effectively lend to them to buy that and put in the horizontal infrastructure. So you have to put in roads and sewers and electricity, and that takes a couple of years. And then they start to sell those lots to build homes. So that takes about probably 3 years. And so
that's a lag from the time the capital comes in the door until the time the revenue starts flowing in, obviously.
Right. And so that ended up being a good... It's funny because when we were telling everybody that briefly in 2022, our investors were a little bit like worried because they thought housing would get hurt, but instead the home builders have been very, very successful. This is what I'm saying about like housing has come into favor, and there's more risk taking in housing, and we're not putting more capital into it today. And I could get into sort of home builder finance, and it's really interesting. it's a totally different part of the market, but it's like I'm trying to just sort of summarize it in that it's now got too much. We stopped putting money into home builder finance because it's gotten much more amply supplied by other capital providers. There's much more home building than there was, and it seems like the risk is not worth taking for the reward you might get. And so,
So earlier on, going back 2-3 years, you saw that you were being rewarded for the risk that you were taking in the form of higher yields on the private credit funds. Obviously, now you're saying there's more capital flowing to. And by the way, there are a lot of ways that retail investors do play these, whether it's in REITs or in ETFs, some of which are leveraged, some of which are not. But this idea that essentially that what you're seeing right now is there's enough capital flow to that market that it doesn't pay you the risk, the reward on the risk that you need to get. But it's interesting because I almost hear something that might sound, and I don't want to be alarmist here, but it might sound a little bit ominous to some of our viewers and our listeners at home when someone who had been lending into a market essentially says, I'm not bidding anymore.
yeah, it's funny. I mean, fortunately, we don't have to deploy billions, so we can be surgical, and what you have to do is what we have done is you go into a market before the institutions go there, and then when they show up, you start to leave the market. But often I find that I'm really
Did
early.
you exit those positions, or are you holding them to maturity, or are they somewhere in between where you're offloading some of it?
It's somewhere in between. I mean, I'm not worried about our risk because again, like you can't look at the yield, you have to look at your basis. And so the fact that we're buying this land or lending in this land, effectively it's like a structured lending program at land prices that have since maybe doubled, right? It's like I'm not that worried about, and they're also it takes a long time for that land to get developed and get ready to be sold. So the fact that our pipeline is more mature means also lower risk. And the point is that I'm personally not worried about the profile of our current portfolio. And I'm finding lenders are coming to us, big ones, and home builders and taking them off our hands early because it's just like there's such voracious demand for this asset class, which is now being institutionalized, which is home builder finance, or some people call it land banking, but it's so I can get sort of into it technically, but the broader point, going full circle, is that risk markets are back. There's risk taking, there's capital, and that, I mean, and you can look at that and you could say, well, that happens. You look at the 2008 financial crisis, like risk markets were back. Stock market sort of peaked shortly before it collapsed. Same with in year 2000. So you can look at it that way, or you can say, oh no, this is actually going to facilitate a soft landing because there's ample capital, and it's not these risks we're talking about. Like they're not risks I would take now, but they're not absurd, right? Like it's so I.
And that's the implication for the soft landing scenario, that you don't believe that the risk taking has been absurd. You just don't believe it was as favorable as it was 2 years ago when you took the risk. And just to underline this, essentially what you were saying, the reason that you're not worried about your own book of assets, in your view, is because if you're lending against land and it's risen by 50% since you took those initial risks by lending in the private credit markets, then the implication is that even if there were a drawdown from the peak price, you're still protected because of the cash flow that those properties can generate relative to where you took the lending decisions.
Yeah, and the home building industry is really matured. It's like people don't appreciate how much the home building industry has developed since the 2008 financial crisis, and it used to be a wild, wild west. And since 2008, it's become institutionalized. It's much more efficient. They use technology, and so I think that there's a strong argument that the home builders going to they could weather a storm. And so like lending into that ecosystem, I think that is a good argument for it, even though I think we're not. I can make the argument both ways, even though at the end of the day, I say we're not going to. And so what I've tried to do, right, is I take, we are in the asset-backed securities market, we're in the home building finance market, we're in the apartment market, we're in the technology market, we sit across a lot of the sort of economy, and it gives me a sense of what's happening, and I sort of boils down to if because no one believes there's going to be a hard landing anymore, a lot more risk is being taken, and that could be a very positive sign because it's self-fulfilling. That it's hard to have a hard landing when there's a lot of risk taking in the market, right? There's a lot of money. Usually, there's a hard landing because there's things just go worse, and it just doesn't seem like. It seems like the Fed may pull off the immaculate landing, even though I think there's a 20% tail risk that they don't, because of things they can't control, like politics or or global geopolitical events. So that's. I mean, I was convinced there was going to be a recession, and I now think that there will be one, but it's not going to be as extreme as I feared.
Ben, we have a few minutes left, but I wanted to take a look at two charts in your deck that I think are especially compelling because they speak to precisely these points. The first one on page 5, the annual net absorption of market rate apartments in the US. Walk us through this chart. Explain what we're about to see on the screen in just a second.
Yeah. Well, I want to show you this slide and the one that's sort of underneath of it. But so you're seeing the net absorption, which you saw is that it went negative in 2020.
What does that mean? Net absorption? That's not a phrase that most people in the retail markets are familiar with.
So net absorption is the total amount of supply of rental housing kind of minus the total amount of demand, or demand minus supply minus demand. So you have sort of net. So if you have in Nashville 10,000 new renters, but you've built 20,000 new apartments, then your net absorption is negative 10,000, right? So you saw oversupply of housing in rental apartments, and there was more supply of new apartments than there was demand for new apartments. And then and everybody in the real estate market thought 2024 was going to be a bloodbath, and the absorption demand shocked everybody because supply is easy to measure. You can see what's under construction and you can know when it's going to deliver. But the demand really surprised people. And that's because of two things. One is that higher rates meant less people were buying homes, and so more people were renting. But the thing that was most surprising, which I think is this slide before this, which is the demographic shift. And so this is John Burns. I love their work. John Burns, Real Estate Consulting. I think they're the best source of data for housing. And so what you're looking at here is the annual number of new working age population, right? So if you look at the 80s or 70s or 2000s, we were adding 2 million new workers to the US population every year.
Okay, and this is growth. So this is the second derivative. This is the change, not the aggregate number on a stock basis of workers. This is the net change.
Yes, yeah. So what you saw, US has been growing for 200 years, right? We would add, immigration, and people would have kids, and those kids would eventually turn 18 or 20 and go to work. And so you had growth in the working age population in America for the last a couple hundred years. And then what happened since 2008 financial crisis is that people started having less kids, and then COVID, people even had less, and so you really saw a fall in number of natural births in America. Plus, immigration policies really started tightening up, and we started seeing at the end of 2019 that we were on the path of having no more growth in working age population. So,
Two interesting things jump out at me at this chart.
Yes.
Number one is on the left, where you see those bars being the highest. That is the period of highest inflation that we've seen in our lifetimes in this country. The period after the early 1970s into the early 1980s. The second is this: that as population in aggregate rises, these increases on an absolute quanta level represent smaller increase on a percent change basis.
Yes, I mean, and this story, which you probably have a demographics expert on the show, but this is one of the three most important things happening in the world today. Is that demographics in the world, human population, are radically changing. I mean, you're talking about demographic growth in the world was a fact for 100,000 years. The only period where you saw extended demographic decline was in the 1300s because of bubonic plague, and that I think 30% of people in Europe died, and that caused the collapse of feudalism and the beginning of Renaissance. And so, a period of demographic decline is like we're uncharted territory. And so that's a global phenomenon, Western phenomenon, developed nation phenomenon. But the United States was on that path, and I think that path was a dangerous path. And then we just had an immigration surge, legal and illegal, and we can talk about the political decision of whether that was good or bad. But from an economic decision point of view, it's been extremely good for housing, for real estate, and for just aggregate growth. And so that's been a shock to the system, absolute shock to so many parts of the economy.
And we're just getting started here. And I know we're about to run out of time, but this is a big, obviously, political, philosophical, and obviously economic issue as well. I just want to show the last slide here because this was really striking to me as well. This is the new homes sold by sales price. This is a pretty striking chart. We're going to see it in just a second.
Yes. Yeah. I tried to bring some data so people could. This is also from John Burns, and John Burns is, again, I'm just gonna, since I'm showing their work, I want to give them all the credit. But you're seeing a lot of lines on this page, but the two lines that focus on the upper right pink line, the number of expensive homes being built in America has skyrocketed, right? So obviously partly it's a base effect because of inflation, but home builders are building more expensive homes than ever before. And then the $200,000 home, they're building much less of the affordable homes. And I think why I like this slide is that a lot of times what's happening in a market is a microcosm of a larger macro dynamic, and that is in this world, half the economy, half of the consumers in America have fixed rate long-term debt, and so they're really wealthy and healthy. Half of the consumers do not have fixed rate debt, and they are seeing the full brunt of these high interest rates. And so you have this sort of divided economic environment between those who have and those who have not. And that is very difficult to then determine a policy where because rates have an asymmetric effect. And you're seeing that here, and that just the low income buyer can't afford to buy homes, so the home builders aren't building them.
And this is such a great chart because it talks directly to the political and cultural questions that we have right now. And by the way, one of the things that's highly correlated to, I would imagine, is age. So you have, folks out there who bought houses in the 70s, 80s, 90s, fixed rates, who've done extremely, extremely well. And then you have people in their 20s out there who are really attempting to figure out, hey, where's my slice of the American dream? How am I going to form a household, form a family, raise children the way my parents and grandparents did? Because housing is remarkably unaffordable, as you said. As a consequence, you see the inability to find supply creation to meet those demands. Boy, this is a powerful slide, a powerful conversation. Ben, I know we've just barely scratched the surface with this. We're going to have to just have you back to continue this conversation and talk more about it. And I'm still learning about this as well. I spend most of my time focusing on public markets. By the way, if you were confused in this, you're not alone. I was a little bit confused. Private markets are very confusing. Asset-backed securities and the way that people, investors in real estate think, it's very complicated. And we're going to have you come back and talk about this some more. But what are the final thoughts and key takeaways that you'd like to leave our viewers and our listeners with?
Maybe I'll go with this slide here, which is that a lot of times what's unclear in the short run is clear in the long run. And what's clear in the long run is higher rates make things less affordable. The country has a lot of debt, and it's just a matter of time before that starts to bite. And so the path of interest rates in the near term is uncertain, but in the long term, there's no way to afford the debt service we have at higher rates without rates coming down. And so we're going to be in this sort of like a choppy period, but the argument that rates don't come down, I think, does not hold water for me.
So that means the Fed's going to have no choice but to cut because of the debt, because of the weight of all of the debt stock. The amount of debt repriced is recessionary. Like there's no way out of that, fact. And so it's a question of time, not a question of if. And so that's, in the short run, you can trade the market, but in the long run, you just have to be aware that America's debt levels are too high to afford interest rates where they are today. Really interesting stuff. Don't be ashamed if you have to watch this twice. I think I probably have to watch it again myself. But Ben, fantastic conversation. Hope you come back and join us again soon.
Yeah, thanks for having me.
Thanks for listening. Thanks for watching. Have a great afternoon, everybody.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.